So we'll look at what a typical lease event is. Why do investors want to know about them? Why is it so important to them? And also, how do we forecast them? The fourth one is the average vacancy period. Now, this is just the average vacancy between leases. Now, this matters because longer vacancy periods lead to loss of rental income and increased operational costs. So I want to take you back to the pre-COVID period or just around about the COVID period when people were not really going to shopping centres, etc. So the retail sector wasn't doing that well in the actual shops, but warehouses were doing quite well because people need to, or business need to store their goods in commercial warehouses so that they can then ship them out via courier, etc. to people's homes. And now we need to run a quick equation. Now I'm just going to run this equation and explain exactly what this means. What does this mean? Well, the C, which is our constant term, remember the constant term, it basically says that if the vacancy rate and net absorption were equal to 0, if nothing moved there, then the renewal rate will be 77.8% likely to renew. I think the best thing to do now would be go and see what they look like in the real world. So these values are very, very close to here. It's probably better to see that if we just provide a very quick graph. Let's just put these in. Let's just put a really quick graph here. And here we go. So we can see these values are very, very close. And that's actually really good forecast because what we've just forecasted now, pretending we're back in 2020, aligns very closely to what happened in the real world. And these are trends taken from our data providers, trends taken from that time. It's actually a really good model. Welcome. In this video, I'll be walking you through how we forecast commercial real estate lease events. I'll start by explaining what they are and why they matter. And then I'll take you through a simple example to show you how it all works. Let's get started. So we'll look at what a typical lease event is. Why do investors want to know about them? Why is it so important to them? And also, how do we forecast them? Well, the first one we'll come across is the propensity to renew. Now, this is the likelihood that existing tenants renew their leases at the end of the current term. Now, why is this important? Well, a high propensity to renew reduces turnover costs. It also minimizes vacancy risks and stabilizes rental income. And investors actually care about this because they use this metric to gauge long-term income stability, and they also plan for potential lease renegotiations. The second one is the propensity to break. Now, this is the probability that a tenant will break their clause early. And this is important because higher break rates can disrupt cash flows and increase reletting costs. Understanding break risks help investors manage income volatility, and they also plan for potential releasing efforts. The third one is the probability of tenant default. Now, this is simply the likelihood of tenants defaulting and going through the courts and all sorts of legal obligations and all that type of thing. This is important because tenant defaults can result in unpaid rent, legal expenses, and longer vacancy periods. Investors can also assess default risk to mitigate financial losses and ensure portfolio resilience. The fourth one is the average vacancy period. Now, this is just the average vacancy between leases. Now, this matters because longer vacancy periods lead to loss of rental income and increased operational costs. Investors request forecasts for vacancy periods so that they can manage their cash flow projections and determine leasing strategies. And the final one we'll come to are new lease terms. Now, new lease terms influence market rent trends and tenant demand, and also investment returns. Investors analyze new lease terms to, benchmark rental growth, negotiate future leases, and assess market competitiveness. So now I'm going to look at a real-world example, and this is going to come from the industrial real estate market region of Texas, so made up of Dallas, Houston, and Austin, and these are actually average prices that were average rates, and we'll see that when we come to the actual numbers. So I want to take you back to the pre-COVID period, or just around about the COVID period when people were not really going to shopping centres, etc. So the retail sector wasn't doing that well in the actual shops, but warehouses were doing quite well because people need to, or business need to store their goods in commercial warehouses so that they can then ship them out via courier, etc. to people's homes. GDP growth at that time was doing reasonably well, and there were lower vacancy rates, which are around about 10%. And default rates were reasonably stable at that time. And this is the data it's going to come from. Now, not to be too alarmed by this, for those who haven't done econometrics, people who have done econometrics will recognize this. I'm just going to go through briefly what this actually means. Now, you'll see this Y value here. This is what we're trying to find out. So Y is what we're trying to find out. It could be anything. It could be renewal rates. It could be rent prices of commercial real estate. It could be anything. But what we're saying is that this Y value here is dependent on these beta values. And we can see this beta 1 and beta 2. Let's just keep this really simple. So we're going to just take a student trying to pass a maths exam during the course of a year. And this Y, trying to pass his maths exam, is dependent on, for example, dependent on studying. So you have to study to be able to pass this maths exam. It's also dependent on beta 2, which is consistent note-taking, for example. So in order to pass this maths exam, you need to be taking notes consistently and you need to be studying. And the probability then could be 50%, 60, 70, 80%, who knows? And this is what we're trying to establish. Beta 0, however, says that if you hold beta 1 and beta 2 constant, which means if you don't take notes and you don't study, there will still be some sort of probability that you'll pass the exam. It could be 1%, it could be 5%, it could be 10%. And that's exactly what this means. It's what we're trying to find out. E is called the error term, and this basically means that the lower the error term, so the lower this numerical value, the better our model fits and the more we can rely on the results. So here's our real world example. And what we're trying to do now is to forecast the renewal rate. Now, what we have here, if you go back to our econometric equation, which basically said that Y is dependent on X values, these are X values here, or beta values, and this is our Y value, what we're trying to find out. Now, we're going to pretend that we're back in 2020 and we have no idea what the renewal rate is for 2021 to 2023. But what we do have from our data providers is not just a history of vacancy rate and net absorption, and also as a renewal rate going up to 2020, but we also have forecasted values for 2021, 22, and 23, because they provide us with forecasted values of things like GDP, etc. And we also have this from them, vacancy rate and net absorption, to be able to work out what we don't know, which is our renewal rate. And this is our task to work this out. So I use a system called eViews, and what eViews does, it allows me to get a forecast. Now, these are the real values. What I should say, actually, just go back a bit, is that the renewal rates from the average of those three states are not actual rates, but they are taken from trends that came out from data from that time. So these are actual trends, not actual historic. If you want actual historic data, you're going to have to go to subscribe to sort of different data providers, etc. But what we're trying to find out is 2021 to 2023 renewal rates. And I'm going to take this data now and put it into eViews. And we're going to take a brand new work file. Oops, let's just do this properly. And start from 2013 to 2023. And we'll put the data in here. So 2013. Finish. Here we go. And now we need to run a quick equation. Now I'm just going to run this equation and explain exactly what this means. So we want to work out the renewal rate, which is dependent on the constant term, which you remember, and also the vacancy rate, and also the net absorption rate. And now we should be able to get, here's our result. So what does this exactly mean? Let me just take you to here. The probability here. So probability, this is our p-value. We call it the p-value. If this is less than 5%, or there or thereabouts, we can see here 5% it will be 0.05. If it's 0.05 or lower, we can say that this is a reliable piece of information. We can see that all these values are less than 5%. This one's slightly above. We can say it's actually quite a good fit. What does this mean? Well, the C, which is our constant term, remember the constant term, it basically says that if the vacancy rate and net absorption were equal to 0, if nothing moved there, then the renewal rate will be 77.8% likely to renew. It also says that, we can have a look at this vacancy rate, minus 3.15. What this means is that if the vacancy rate increased by 1%, the renewal rate will decrease by 3.15%. Also, the net absorption rate here, we can see it's 0.42, and it says that if a 1 million square foot property increases net absorption by 1%, the renewal rate will increase by 0.42. And we can see that that's actually quite consistent with theory, and that's actually a really good model. It's a good model here. You can see the R squared is 98%, and we can say that this is a reliable piece of information. So we can take these values here and provide a forecast. And here's the forecast now. I'm just going to do that. So 2021, we're trying to forecast out to 2023. 23, and this is our new forecast. So this is just a graph of the new forecast value. You can actually see it properly if we look at proper values. And 2021, 22, 23, I'm just going to copy that now and put in here. So these are new forecasted values. I think the best thing to do now would be go and see what they look like in the real world. So these values are very, very close to here. It's probably better to see that if we just provide a very quick graph. Let's just put these in. Let's just put a really quick graph here. And here we go. So we can see these values are very, very close. And that's actually really good forecast, because what we've just forecasted now, pretending we're back in 2020, aligns very closely to what happened in the real world. And these are trends taken from our data providers, trends taken from that time. That's really good. It's a really good, it's actually a really good model. So we're quite happy with our forecast. So this is how we forecast lease events, and this is just a very basic one. There are, I use a variety of information, I use a variety of data, and do sort of, a lot more complex econometrics equations, like econometrics forecasting, like this. Been doing it for many, many years. And this is just a simple example to show you how it actually works in the real world. And we're happy with this particular outcome, which is great. So that was just a very quick showing of how we do lease event forecasting in the commercial real estate world. And I hope that was useful. If it was useful, I've got an expression of interest form down below. Just put your name and email address, and I'll just keep you updated with more of these kind of videos and what we're getting up to. So thank you very much for watching, and see you again next time.